Peter Kellner is the founder and CEO of Richmond Global Compass. Thanks for joining us this morning. So my background is in the chemical sector, in chemicals banking, and I can just remember for years at capital markets days with these companies, when management would move on to the sustainability side of the presentation, investors' eyes would really glaze over. It wasn't central to the investment case, but increasingly ESG is a hugely important criteria for investors. How much has really changed in terms of investor thinking and the importance of companies' ESG strategies when it comes to investment choosing?
So I think it's, excuse me, I think it's changing quite dramatically. The challenge we have is definitional. What is environmental, social, and governance? What are those metrics, and how good is the data? And today it's actually not very good. So, you know, in 20 years ago we were screening, which I don't think is a particularly good policy, particularly in liquid global capital markets, which is where we're focused. But again, around the data itself, we need to get better at that if we're going to be cogent in our arguments about pricing and why ESG metrics can actually affect financial performance. We often call these non-financial factors that affect financial performance. As a fund, we're a liquid global multi-asset fund. We have used data science that we've built proprietarily to use that to integrate into our financial analysis across corporate and sovereign securities. And we are showing that that is a research edge, an informational edge. These metrics, if you can correctly derive them, turf up information that otherwise you're just not going to find, and allow you for better portfolio management.
So you're taking measures at your level, and in terms of government or authorities' oversight and regulation of these different criteria, the European Commission just published a classification system that basically details what economic activities are green. To your point about it so far lacking structure, is this new initiative a good idea?
Look, I think any initiative is a good idea. Let's start poking holes in it. So I'm not one to say whether it's good or bad. I know all about it. I just haven't really gotten into the details. For me, what's important is what we've developed. And what we've developed is an empirically derived set of data that allows us to assess corporate and sovereign securities from an informational standpoint. So one of our partners is HBS professor George Serafin. He's probably the leading ESG authority globally. He proved out in 2015 that if you focus on these material ESG factors against liquid corporate securities, you can achieve 6% in accretive alpha. I took that study and applied it to sovereigns and found similar predictive correlation. So we do believe at some point we're going to get there in terms of driving performance. Today, we're showing that it's informationally a great advantage.
Peter, it sounds amazing and new and scientific, but in many ways, you're just doing old-fashioned groundwork, which other people should have been doing. Are you saying there is a complete and utter lack of competence in the current batch of analysts who are supposed to be doing work like looking at water rights issues, looking at percentage of loans in floods? I would expect any analyst who is doing its due diligence on a company before putting a recommendation that should be doing this stuff anyway.
I would say they should as well. We consider it fiduciary responsibility, okay? But unfortunately today that's not the case. I'm not in the business of denigrating others to promote my case, but I will say that I don't believe that people are rigorous enough today. I think if you're screening, for example, which most of the market is doing today, it's heretofore known, called SRI, it's not rigorous. Saying we just don't do those things and therefore, you know, our research is better than others, or these are the securities we should select. You got to do your work, and that's what is involved when you're integrating these metrics. And you got to really get involved in identifying the right metrics in the first place.
Peter, is an open fund the right vehicle for promoting this aspect of investing? We had Glenmont in yesterday, who have a closed fund that they're using to target green energy in particular. Some of these projects have very long payback periods, and you need to be in there for the long run. With what we've seen with Woodford and H2O recently, isn't there a sort of risk that as you pursue the ESG mandate, you gradually move to more illiquid assets?
So I don't know if that's necessarily the case. I'm not a proponent of the open fund model right now, for me at least. For our investors who are high net worth, accredited, qualified, what have you, it is a longer term. I mean, our portfolio churns 25% annually, and we're trading sovereigns, currencies, equities, you name it. High yield, corporate US high yield right now. We have a steepener on. But we're churning 25% per annum. We're very long-focused, long-term focused. So for me, this is something that's going to require us doing our work. We want to deliver returns first. We believe that the ESG metrics drive that return. I don't know for the retail investor today, if that's part of your question, whether we can offer, given the state of data, whether we can offer them a fair assessment of what's happening. And that's just my personal perspective.